Move from mortgage protection to mortgage acceleration.
What if I could show you how to get out of debt 2.5 years faster by not giving that money to the mortgage company? If you give it to the mortgage company, there's only one way to get your money back out of the house, and that's to qualify for a loan. And when you need it the worst, it's the hardest to get. It would be better to put it into an insurance policy. You can get the money out anytime you want. You don't have to qualify for anything. They said, you know what? Americans are making the wrong choice if they're sending extra principal payments to the mortgage company.
A lot of advisors will help you get insurance on your life so that if you happen to pass away with an untimely death, there's enough death benefit to pay off your mortgage so that your heirs, your spouse, your widow, or whatever will not be strapped with that mortgage payment. Your house can be paid off. Well, that may sound good, but there's a far better way to accomplish that goal and actually accelerate the payoff of your mortgage at the same time. You can kill two birds with one stone. Get ready, I'm gonna blow you away. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and empower their authentic wealth. Years ago, and I'm talking about 45, 50 years ago, I helped many Americans that were taking out mortgages on their homes where they were interested in mortgage protection. In other words, they wanted to get some life insurance, a term policy, that they could purchase to pay off the mortgage if the breadwinner had an untimely death, which is a good goal. But then I would go out and say, well, what if I showed you how you could put money into this insurance contract, which was a max funded indexed universal life, okay? If I could show you how to put this money in there, and they say, well, we don't have any extra money. And I go, well, wait a minute here. You have a plan to send an extra, like $500 a month to the mortgage company to get it paid off faster, right? Well, yeah, we want to get out of debt faster. Or I see here that you were actually interested in a 15-year amortized mortgage instead of a 30-year amortized mortgage. Well, yeah, we figured we could just bite the bullet and pay a higher mortgage payment, and our house will be paid off in 15 years. I said, that's the money I'm talking about. You can do far better with that money than giving it to the mortgage company. And they go, what are you talking about? I go, okay, I've got to teach you how money works, and we can move from just mortgage protection to mortgage acceleration. What if I could show you how to get out of debt 2.5 years faster by not giving that money to the mortgage company? Well, yeah, we're all ears. Okay. So in order to do that, I would say, in order to get you out of debt 2.5 years faster, that means we've got to set up a plan where you can be disciplined to set aside that amount that you're going to send to the mortgage company, or you're considering a 15-year amortized mortgage payment, which is this, let's say. And you know that a 30-year amortized mortgage payment is less. So I'm going to calculate the difference between the 15-year amortized mortgage payment and the 30-year, but I'm also going to calculate the tax savings you will achieve during the first 15 years of a 30-year mortgage. And instead of just having that go down the drain, we're going to also use that, okay? So instead of just the difference, it's also going to include the tax savings you will achieve during the first 15 years of a 30-year mortgage by not killing your partner, Uncle Sam, by paying down the mortgage and getting rid of that tax deduction. Does that make sense? Oh, yeah. So I would create the illustration and we would set aside that difference. Then I would punch it into an HP12C calculator and they would be flabbergasted. And I remember doing this with 3 finance professors that taught their advanced students why they should take out a 15-year amortized mortgage instead of a 30-year on the purchase of their first home to save a bunch of interest. And I said, gentlemen, you're finance professors. Haven't you ever taken that differential between a 15-year amortized mortgage payment and a 30-year amortized plus the tax savings and put it into a side fund compounding tax-free? And then they would go, well, what's tax-free? And then I had to explain to them what a property structure max funded indexed insurance contract was and why it's income tax-free. Well, no, we've never done that. And then they were flabbergasted when they saw that in 12 and a half years, there was enough money in the max funded indexed universal life. And if it's structured correctly, it's called a L.A.S.E.R fund. Liquid Asset Safely Earning Return spells the acronym L.A.S.E.R. They would have enough money in 12 and a half years to totally pay off the 30-year mortgage 2.5 years faster than the same money given to the 15-year mortgage, okay? And they were blown away. And not only that, you had liquidity and safety. You could access money in the event of an emergency. You give the money to the mortgage company. There's only one way to get it back if you need it back. If you're unemployed, you get sick, you get disabled. The number one cause of home foreclosure in America is physical disability. Well, the chance of you having a temporary financial disability is even greater. If you give it to the mortgage company, there's only one way to get your money back out of the house, and that's to qualify for a loan. And when you need it the worst, it's the hardest to get. It would be better to put it into an insurance policy. You can get the money out anytime you want. You don't have to qualify for anything. Too many people learn that lesson the hard way. Well, and I did, by the way, back in 1982. So I often ask, what do you get when you multiply one negative by another negative? Okay, a negative 2 times a negative 2 equals what? A positive 4. Well, what am I talking about? Most people view paying interest as a negative. Well, I got to hurry and get rid of this interest I'm paying. Not banks and credit unions, not insurance companies. They are multi-trillion-dollar institutions, and they would wither up and die if they stopped paying interest. They don't view interest as a liability. It's one of their greatest assets is their liabilities, okay? If they stopped borrowing OPM, other people's money, and paying interest, they would wither up and die, but they learn how money works. They understand that by paying interest, okay, they can then use that money and make higher interest than what they're paying by 2 or 3 times. You can too. I'm going to show you. So paying interest is not a negative, it's a positive. But sometimes people view insurance, I've got to put insurance on myself or on my house. That's a negative. No, I'm going to show you how to take that perceived negative and make it a huge positive. And that's by putting that extra money, okay, that you would be tempted to give to the mortgage company in an extra principal payment, put it into a compounding account tax-free in an insurance policy, an insurance contract. And that's what helps you pay off your house 2.5 years faster. 2 negatives turn into a huge positive. Now, let me just make sure you understand. A mortgage, an amortized mortgage, okay, as you pay it down, you're paying simple interest on a declining balance tax deductible. If I borrow money at 6% interest in a 33% tax bracket, it doesn't cost me 6%, it costs me a net of 4, okay? On $1 million mortgage, I'm paying $60,000, but I get to write off $60,000 on my tax return as tax deductible interest if I do it right. In a 33% bracket, I saved 1/3 of that $60,000 deduction in tax, which is $20,000. So the net cost of a $60,000 interest is only $40,000 because I get $20,000 back at a tax refund, or $20,000 less taxes I paid. Does that make sense? If I borrow money at 4.5% tax deductible interest, it's a net cost of $3,000. Well, over here in my L.A.S.E.R fund, I'm earning compound interest tax-free. If I'm earning compound interest like I have, a 9 to 10% net internal rates of return, how much more is 9 than 3? Don't say 6. It's 3 times, it's 300% more. On $1 million mortgage, I'm paying at 4.5% tax deductible interest, a net cost of $3,000 or $30,000 a year. But I'm making $90,000 over here. That's just the first year, by the way. I make $90,000. It cost me $30,000. Would you hire an employee for $30,000? If that employee made you an extra $90,000, that's called a 300% return on employment cost. Business owners understand this. Would you buy a widget machine for $30,000 that made you an extra $90,000? That's called a 300% return on equipment. You can make 300% rates of return. This is compound interest tax-free compared to simple interest declining balance tax deductible. Sometimes I borrowed money at 3% tax deductible interest, a net cost of 2, and I've made 10 over here. I've made 500% more. I don't care if you borrow money at 6% tax deductible interest, a net cost of 4, and you only earn 8 over here. How much more is 8 than 4? 100% more. That's 100% rate of return. Pretty soon, this compounding account over on this side will compound to an amount equal to be able to pay off the mortgage 2.5 years or sooner by not giving it to the mortgage company, okay? But it's liquid safe over here. If you give it to the mortgage company, there's only one way to get it back out of that house, and that's to borrow or sell the house. Are you getting it? Okay. So I've helped thousands of people get out of debt. Yeah, there's quick and smart ways. Send extra principal payments, do a 15-year mortgage. There's smarter and quicker ways, but the smartest and quickest way is not any way, shape, or form sending extra principal payments to the mortgage company. I can prove that to you mathematically all day long. Now, sometimes it begins by understanding the difference between preferred and non-preferred interest expense. So let me back up again. If I have two couples and they both make $72,000 a year, one has $12,000 of interest that is non-preferred. It's on automobiles or things that are not deductible. They have $60,000 after paying the interest. Okay, that's how much they have before tax. If I have a couple that make $72,000, they have $12,000 of interest that's secured by a piece of real estate, their home or a rental property that is deductible. They have the same $60,000, but what's the difference? This couple has to pay tax on the full 72. This couple only has to pay tax on the 60 because it was deductible. That's a difference of taxable income of 12 grand. In a 33% bracket, this couple is paying out $4,000 more. This couple is saving $4,000 of otherwise payable tax. That's real money. It's not paper money. Okay. That's what I'm talking about here. So you want to leverage with full liquidity. Now, the people who leverage without liquidity, that's stupidity. Let me make sure you understand what I'm talking about. If somebody says, I've got $500,000 of cash, I could pay cash for this piece of property. Okay, that now you own it free and clear, but now it's earning, the equity is earning nothing. I mean, the house is going to appreciate or depreciate regardless of how much equity is in it. Equity has no rate of return. Only when you separate it does it have the ability to earn a rate of return. But let's say that you say, well, okay, I'm going to put $100,000 of my $500,000 in a 20% down payment on a $500,000 rental home and another $100,000 on the next rental home. So you buy 5 rental homes. Now you have $2.5 million of real estate. But all of your $500,000 of liquid cash is tied up in down payments on those properties. You leveraged $500,000 into $2.5 million of real estate with no liquidity. That's stupid. If you get into trouble and you have vacancies or we have a recession, there's only one way to get your $500,000 back, and that's to sell those properties or to borrow. And you can't qualify for a loan, and if you sell it in a depressed market, you're going to be lucky to get 80 cents on the dollar. You just lost your $500,000. I've seen it happen thousands of times. Not me. I keep my $500,000 over here in a L.A.S.E.R fund. Now, I satisfy down payments, but not with my money. I do first mortgages, 80% loan to value, and then I take out a second mortgage for the last 20%. So I borrow 100% and I keep my 500 grand over here. Not only that, but as the property keeps appreciating, I have the wherewithal. When I have positive cash flow, I keep it accumulating over here. I don't give it to the mortgage company. If I get into trouble, I can peel off the interest on my money over here and make all the mortgage payments, okay? I can take the money and keep the properties. I'm not subject to the whims of the mortgage lender. I have liquidity. So when you leverage without liquidity, that's stupidity. Are you getting it? Okay, now let's go back to the math. One time, there was this company that had this software that they sold for $800. And they said, listen, if you buy this software, it'll show you which credit cards you should pay off first if you want to get out of debt. The 18% interest credit card or the 12% interest. This isn't rocket science. You don't need software for that. But basically, you've seen where they tell you, okay, you pay off the highest interest credit card first, and then you take what you were paying on that, and you pay it to the next and the next and the next one. Then you pay off your car loans, and then you put all that money against your mortgages. Okay, So their software showed this person taking all of this money they were paying on automobile loans and credit cards and plowed it against the mortgage. And wow, in 12 and a half years, you pay off your mortgage. Now your house is paid off. Now you take what you used to pay in all those payments and you put it into a tax-deferred IRA or 401k, let's say earning 8%, and you end up with just under $1 million in a tax-deferred account. That's good. But I have a little ditty, good, better, best, never let it rest. Never let it rest till good gets better and better gets best. That may be a good way to go, but it's a far cry from the best way. You want to see the best way? Well, let's start with the better way first. Instead of this, you have $987,000 in a tax-deferred IRA. If I go to access money out of that, I have to pay tax. A third of that belongs to Uncle Sam. I'm really only netting about $650,000 after tax. So far, so good. I can show you how to have double that by not giving it to the mortgage company. So here's a better way. Instead of giving it to the mortgage company, I take all that extra money by paying off those credit cards and extra principal payments, and I put it into a L.A.S.E.R fund, compounding tax-free. And I'll have enough money in 10.2 years, 2.3 years sooner, in my L.A.S.E.R fund to totally pay off the house. Let's say I physically do that. I'm out of debt 2.3 years sooner. Now that will grow to $1,245,000, which is twice as much money as this method was after tax. This after tax is only worth $650. This is worth double that. That's a better way. You want to see the best way? When I have enough money in 10.2 years to pay off the mortgage, I physically don't do it. Why would I fire an employee that's making me double or triple what they're costing me? That's dumb. I am out of debt. On my balance sheet, my assets, anytime with an electronic funds transfer or phone call, I can pay off my mortgage in 10.2 years. By continuing to earn 100 to 200 to 300% more than the cost of the mortgage, I will end up with $1,800,000 at the end of the same time period instead of just a net of $600,000. Triple, 3 times as much money using the same dollars. That's the best way to get out of debt. So the difference is the good way, you're going to pay $96,000 in taxes because you killed your tax deductions. Or the better way, you're still going to pay $83,000 in taxes. The best way, you pay $0 in the same illustration. Good, better, best. The difference between what you put in and the difference of what you accumulated, here is $500,000 the good way. $750,000 the better way. It's $1,250,000 you turned out to the best way. Math doesn't lie. Good, better, best. I'd rather end up with $1,242,000 net after having $1,800,000 accumulate tax-free. You can do this. Now, if you don't take my word for it, take the Federal Reserve Bank of Chicago's word for it. When I explained this in my second best-selling book, Misfortune 101, that became a bestseller, I proved this mathematically in the book, and the Federal Reserve Bank of Chicago were given a challenge. Would you please check Mr. Andrews' math? After about 3 months of intensive study, these 3 gurus came out with the trade-off between mortgage prepayments and tax-deferred retirement savings. They didn't even use a tax-free L.A.S.E.R fund. They said, you know what? Americans are making the wrong choice if they're sending extra principal payments to the mortgage company. They said those mortgage overpayments are a misallocation of funds in their opinion. You would reap a substantial gain if you did not do that. If you would put it into a compounding account instead of giving it to the mortgage company, you'd come out way ahead. You'll get out of debt faster. And they called this a rather conservative approach. There you go. They're the gurus, and they verified what I have been talking about for years. So if you want to learn more about how to do this, I would strongly recommend that you claim a copy of my book, The L.A.S.E.R Fund. I'll pay for this book. It retails for $20 on Amazon. It's been flying off of our warehouse shelves, and if you buy it on Amazon, thank you. But I'll gift you a copy free. You simply go to laserfund.com or click on the link below, contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll pay for the book. Why should you claim a copy? It's actually 2 books in one. This side, 200 pages, 14 chapters with all the charts and graphs if you're a left-brain learner. If you're a right brain learner, you learn by stories. You flip it over 100 pages, 12 chapters with 62 actual client stories. But this will show you how to diversify and create the foundation for a tax-free retirement. And just a byproduct is you can get out of debt 2.5 years faster and end up with 3 times as much money than the way that most Americans go about getting out of debt and paying off their house. Okay? How to become your own banker. Now, when you go in and claim your free copy, if you like to listen and learn or watch and learn, there's those formats. You can register for a free educational webinar, which we teach on a regular basis. But if you want to talk to an IUL certified professional, you can schedule an appointment with no cost or obligation, and they'll show you how this may work in your particular set of circumstances. And make sure you do it right, because if you don't, it's going to cost you if you go to an IUL agent who does not know how to structure your IUL correctly and help you fund it properly to accomplish what I've been talking about here. So don't make that mistake. Meet with a certified professional and do it right the first time.